Hello, everybody. Welcome to Wednesday. The S&P 500 was up a grand total of 0.1% today. Not a whole lot going on, although we did have some pieces doing quite well with clean energy and online retail, a majority of which were over 1% today. Again, not bad for a day where the market's up only 0.1. Here's a couple of things that I think we should be talking about going forward, just in terms of what's happening. One thing to consider here is something we don't talk about very often, and that is really kind of the bond market. And, one of the things that happens when rates come down, bond values go up. And so that's great. And we saw that happen. And the reason is because an older bond that was paying more becomes worth more, and it actually brings the yield down to kind of current numbers. One of the problems we're facing right now is that rates are very low. And so how much more can bonds go up even in a downturn that we might have, in a stock market downturn? And so they're kind of compressed. There's just not a lot more room to move there. And so what do you do in this particular environment? Well, there's a couple things that you can do, I think, that do help. Number one is just kind of that little bit of the high yield bonds. So high yield bonds, in my opinion, are kind of a cross between a stock and a bond. They basically move quite a bit with the stock market, but they pay a very nice dividend yield. And in economic recovery times, they can do quite well, which is what's been happening, as the economy has recovered here. And this new stimulus that they're talking about, I think, should help high yield bonds. They're more aggressive, so you have to be more careful, especially if you're looking at more conservative portfolio. And so that's why we kind of put in stop losses quite tight against the high yield bonds. Again, we want to make sure that they don't run away from us as far as that goes. But as long as they stay above those stop losses, we continue to make money. The other aspect to take a look at is what's called a TIPS. It's a Treasury Treasury inflation protected security. Sorry. And so what happens there? These are Treasury bonds. They're specially designed to essentially pay more when interest rates go up. And so that's a great way of kind of hedging what happens normally when interest rates go up as bond values go down, just the opposite of what happens on the other direction. So these are designed to be more robust in an upward environment for interest rates, which I think is probably where we should be heading here. Again, because we are so low. We have seen the 10-year Treasury go from 0.7 up to 1.1%, give or take. And so there are some increasing interest rates, which again bring down the value of the bonds. Overall, the bond market is down year to date. And so it's one of those things where, for me, I've got a lot of portfolios with a lot of bonds in them. We do 10 different, risk levels, 10% stock, 20, 30, 40. Obviously, if I'm in a 20% stock portfolio, it means 80% in bonds. And so how do you make that work? And how do you kind of outperform that? And I do think that these Treasury inflation protection securities that we've been buying, quite a bit lately, and some of the high yield bonds, as well as these broad market bonds that we, kind of buy the whole market as far as that goes. So I do think bonds are a really important piece. They are the parachute of the portfolio. And so being able to have that in place offset some of the risk of the stock market. My concern going forward here is just making sure that we manage those properly so that we don't end up with, a lot of problems if inflation does come back, with some vigor here at some point in time. So just something we're watching for. Again, we have a lot of money in that particular area too, and so do you as clients. So that's my main message today. I do think that the stimulus program that they're talking about is going to get through. I think that's going to continue to push the stock market. I can see some of the trends that are happening. I talked about 3D printing yesterday. It did really well today, for example. So the good things are happening on that side. I don't see huge issues there. We're going to have volatility. That's a given, especially at these levels. But the bond portion is something to make sure we pay attention to also. And so that's where we've been making some of those adjustments. So I hope everything is going well for you, and I look forward to talking to you tomorrow. Thank you very much.